Good morning. We will pay attention to the gross profit, cost of sales, and sales price today. It's very important to determine whether the profit on cost price or the profit on sales price is provided. If the profit on cost price is provided, cost price equals 100%. If the profit on sales price is provided, then the sales price equals 100%. If they say gross profit percentage, it means that the profit was made on sales price. It is very important before you do the calculation to determine whether the profit is on cost price or sales price, otherwise your calculations will not be correct. Marette Traders maintains a profit of 40% on cost price. The sales price is $4,200. Because the profit is made on cost price equals 100%, the profit equals 40%, and the sales price will therefore be 140%. They gave us the sales price, so this 140% equals the 4,200. If we want the cost price, the one that I want, 100, divide by the one that I know, 140, times the 4,200, and that will give me 3,000 rand. They make a profit of 40% on sales price. That means the sales price must be 100. They give us the sales price, so that 100% equals 4,200. Profit is 40%, so the cost price must be less than the sales price when we make a profit. So the cost price will be the one that we want, 60, divided by the one that we know, 100, times 4,200, and that will give us 2,520. So you can see all the information was exactly the same, except that the first example, the profit was on cost price, and in the second example, the profit was on sales price. And you get two totally different answers. Marette Traders maintains a profit of 40% on cost price. The cost price is given as 6,000. Because the profit is made on cost price will be 100%, profit 40, so the sales price will be 140%. The price given is the cost price, so the amount 6,000 equals the cost price of 100%. If we want to calculate the sales price, the one that we want, divide by the one that we know, times 6,000 will give me a sales price of 8,400. They maintain a profit of 40% on sales price. The cost price is 6,000. Because the profit is made on sales price is 100%, profit is 40%, cost price is 60%. The cost price equals 6,000 rand because they give us the cost price. If we want to calculate the sales price, the one that I want, divide by the one that I know, times 6,000, and that will give me a sales price of 10,000 rand. When we use the perpetual inventory system, two double entries are recorded when goods are sold. The first double entry will be at sales price. So the bank or debtor is debited with the sales price and the sales account is credited with the sales price. So I increase my bank or debtors and I increase my income for sales. The second double entry is for cost price. An entry increasing or decreasing the inventories must be recorded in the inventory account. So the cost of sales account is the expense, will be increased on the debit side with the cost price. Inventory that is an asset will be credited with the cost price to reduce the inventory. When using the perpetual inventory system, two double entries are also completed when goods are returned by debtors. So the first double entry will be at sales price. The income out of sales must decrease, so we will debit debtors allowances to reduce it with the sales price. The debtors control account will be credited with the sales price to indicate that the debtors owe less money. The second double entry will be at cost price. When the goods are returned by the debtor, the effect must be recorded in the cost of sales account and in the inventory account. The inventory account will be debited with a cost price to increase the inventory because the goods were received back at cost price. Cost of sales account is credited with the cost price to reduce the expense for cost of sales because these goods are not sold anymore. My red trader sold goods to iCloud for $2,800 less 10% trade discount. So before we can record the entry, we first have to deduct the trade discount from the $2,800 to determine what is the actual sales price. Then a profit of 40% on cost price is maintained, so we will also have to calculate the cost price. And remember that although trade discount was given, the cost price must be calculated on the normal sales price. The normal sales price is $2,800. Trade discount of 10% is R280, and the sales price is $2,520. When we calculate the cost price, they said that the profit is made on cost price, therefore the cost price will be 100, profit 40, sales price 140. They give us the sales price, 2,800. We use the normal sales price and we calculate 100 divided by 140 to determine what was the cost price of the goods. When goods are returned and they give you the normal sales price, it means that you will take the returns and first deduct the trade discount to see with how much must you reduce the debtors, because you will not reduce the account with 420. They didn't pay 420 because we gave them this trade discount. If we want to calculate the cost price, we will indicate that the 140% equals 420. So we calculate it on the normal sales price, and then I will multiply with 100, divide by 140 to determine what is the cost price. When we record the sales transaction, we will do two double entries. The first double entry will be to indicate that the debtors, that is an asset, will increase on the debit side with 2,520. The income for sales will increase on the credit side with 2,520. We calculated the cost price as 2,000. So we will create an expense for cost of sales that will increase on the debit side with 2,000, and our asset for inventory will decrease on the credit side with a cost price of 2,000. Remember that the word that you write in the account always indicates that this double entry that I've got there will be on the credit side of my sales account, so that I can see there's my double entry. And for the cost of sales, we will write inventory to indicate that this double entry is in the inventory account. When the goods are returned, we have to reduce the debtors to show that they owe less money, so we will credit them with 378. We want to reduce the sales that we increased our profit with because the goods are returned and is not sold anymore. So I will create debtors allowances. Debtors allowances is used to reduce sales. The inventory was returned, so inventory will be debited to increase the amount of inventory in the business. The goods are not sold anymore, so it means that I will reduce cost of sales. In the accounting equation, Debtors control is debited to increase assets. Sales is credited to increase income that will increase profits. Cost of sales is debited because expenses increase on the debit side, and that will decrease the profits of the business. Inventory is credited to reduce your assets. This is recorded in the debtors journal and an invoice is issued. Debtors allowances is debited to decrease the income of the business, so the profits will decrease. Debtors control is credited to decrease the assets. Inventory was returned, so inventory increases on the debit side. Cost of sales expense must now be decreased, so we will increase the profits, because if we decrease the expense, our profits will increase. And when you reduce the account of a debtor, you will issue a credit note. What did we learn? Before the cost price or sales price is calculated, you must determine whether the profit is made on cost price or whether the profit is made on sales price. When goods are returned, 2 double entries are completed. The first double entry is at sales price, and the second double entry is at cost price. When goods are returned, you must determine whether the amount before discount is provided, because then you have to deduct the trade discount to determine what is the amount. When the amount on the credit note is provided, it means that this is the correct amount and the trade discount was already taken into account.